Hi, I'm Matt Culkin, co-chair of Steptoe's Financial Services Group, and welcome to another episode of Steptoe's Financial Services University. We're pleased to present a series of short, focused conversations with my colleagues from across our firm's various practice groups and offices around the world. Today, we're going to talk about money laundering. I'm joined by my colleague Zoe Osborne in London and Jeff Beatrice in Washington. Zoe, Jeff, thanks for joining. Maybe to start, if I could just ask both of you to introduce yourselves and talk a little bit about your background.
Sure, thanks, Matt. Good morning, everybody, or in the afternoon if that's when you're listening. My name is Jeff Beatrice, and I'm at Steptoe. I'm the co-chair of the Anti-Money Laundering Committee here at the firm. I've spent most of my career at the Department of Justice, prosecuting, among other cases, money laundering cases, and also a lot of export control, sanctions, and other international enforcement-related matters. After that, I spent 5 years as the general counsel for anti-money laundering at Citibank, Citigroup up in New York, and I've been in private practice representing defendants and institutions, help develop their anti-money laundering programs, and helping them negotiate, if when necessary, public enforcement actions.
Thank you, Jeff. And as you can perhaps tell from my accent, I'm in the London office of Steptoe. My name's Zoe Osborne. By way of brief summary, I have about 18 years of experience in financial crime and contentious regulatory investigations. I frequently interact with authorities like the Serious Fraud Office and the Financial Conduct Authority in relation to matters such as money laundering, bribery, fraud, but also regulatory matters like systems and controls failures and market abuse. I also have significant experience in compliance matters, in particular gained during two secondments with two international banks in London.
Well, Zoe, at the risk of maybe starting at too simple an introduction for those of you who are familiar with this space, let's start with the basics. What is money laundering and how does it work?
I'm always happy to answer the simple questions. Thank you, Matt. So I think at its very simplest, money laundering is the act of cleaning money that was generated from criminal activity. In the vast majority of cases, crime generates cash, and that's a problem for people who want to make large purchases like buying a house or buying property, booking a flight. And for that, you generally need a bank account. That's problem number two for the cash-rich criminal. Banks want to know what the source of the funds are, and they want to make sure that they haven't been generated illegally. At its very simplest, money laundering just looks to legitimize money. So a criminal organization, for example, will use one of its cash-based businesses, a restaurant, a casino, a car wash, and it will use that legitimate business to wash through money that it's generated during its illegal business. And that money then makes it through to the bank account of the legitimate business. It can, of course, be far more complicated than that. You have people investing in real estate, in gems, and then you've got the sort of internet cryptocurrency issues as well that makes it far more complicated. Just to give you an idea before we move on to the meat of this, money laundering and the money that is generated through illegal activity is eye-watering. I think the United Nations is currently estimating that between about $8 billion and $2 trillion is generated annually from money laundering.
Wow, thank you for that. And to go from the simple to the complicated, you practice in different jurisdictions. How are the U.S. and the U.K. laws similar, different? And maybe Zoe, we'll start with you.
Sure. So I think for today's purposes, we will concentrate on the laws that govern financial institutions and the systems and controls that they need to have in place in order to detect money laundering. There are, of course, a whole host of laws that also apply to people who actually generate the underlying proceeds of crime. But our experience is certainly that people like that don't watch videos produced by law firms. Jeff, would you like to start with the US?
Sure. To Zoe's point, we're assuming our audience are mainly institutions or even individuals who are more concerned with preventing money laundering than actually engaging in it. So we'll focus on some of the financial institution laws that I think are most important for the audience to be familiar with. And forgive me, I'll really just start with the very basic, which is the Bank Secrecy Act. We refer to it commonly as the BSA. So when we talk about developing anti-money laundering programs, we say the BSA AML program, Bank Secrecy Act Anti-Money Laundering Program. The initial BSA came into effect back in 1970. And interestingly, the initial Bank Secrecy Act really just involved record keeping. At that point, money laundering wasn't considered to be that sophisticated. The banks were required to keep records. So if law enforcement wanted to further an investigation and needed to go to a financial institution where their records they were interested in, they would know the bank would have those records. Over time, it developed into a much more prophylactic program. It became, by this time, there are two main components to the BSA AML. One is to actually develop an anti-money laundering program that not only has the capability of keeping money launderers and laundered funds out of a financial institution, but also to act as a gatekeeper so that a financial institution, which is very broadly defined at this point, has a system in place, a compliance system in place to identify what might be suspicious activity. And depending on how serious and how prevalent that suspicious activity is, a bank or another financial institution may decide not to do business with that particular client or not allow that client to establish an account to begin with. The second component is the actual reporting of that suspicious activity. And that's what we refer to as suspicious activity reports, SARs. So if a bank does identify suspicious activity, they have an obligation to report that in a very formal document to the U.S. government, the Treasury Department, to an agency called FinCEN, the Financial Crimes Enforcement Network. So those two components, up until almost 2001, with the exception of some developments in the criminal statutes, as Zoe indicated, we're not going to focus on today, in the 80s, the Money Laundering Control Act and others. The next major development was the USA Patriot Act, and obviously that came in 2001 in reaction to the attacks on 9/11. And although that law has significantly advanced BSA AML compliance programs, it required a more rigorous, more advanced program. It also allowed for a lot of information sharing with the government and with financial institution to financial institution that didn't exist previously. Really, the biggest developments for our purposes in the USA Patriot Act was its effect on the international banking community. It allowed the U.S. government to be much more aggressive in controlling or monitoring or requesting information internationally based on their ability to prevent foreign financial institutions from doing business in the U.S. I think with that, I'll turn it over to Zoe.
Thank you, Jeff. Yeah, just so over the pond, the UK's money laundering regime is typically in three regulations: in the Proceeds of Crime Act, the Money Laundering Regulations, and the Terrorism Act. Similar to what Jeff has said, I think the regimes are quite similar, but just to mention, I think, two particular points about the UK regime. So the constituent parts of the offences are very broadly defined. The offences require knowledge or suspicion that relevant property is criminal property. Suspicion is incredibly broadly defined in the UK, and it can be as simple as just simply noticing that something is unusual or unexpected. Likewise, criminal proceeds is very broadly defined and covers proceeds from any criminal activity. I think the second point that's worth noting is that the defences, in contrast to the offences, are very, very limited and they're extremely narrowly defined. Similar to the US, and we'll go on to talk about that, the UK regime does require financial institutions to have appropriate controls in place, including relation to due diligence on one's customers, monitoring transactions, and also a range of reporting requirements, as Jeff has already mentioned. I just mentioned very briefly that there are similarities, I think very great similarities between a number of the regimes, particularly the UK and the US, but there are nuances, and firms operating on a global basis should be aware of those nuances.
So thank you both for that. That's probably the best synopsis I've ever heard about what we're talking about and how the regimes operate in multiple jurisdictions. But let's now flip to maybe more practical discussion for those watching who live in this space. When you think about it from a compliance perspective for financial services firms, and maybe Jeff, I'll start with you given your background. What are the reasons that either executives should care, or what are the overarching goals of the internal AML policies and procedures?
Sure, Matt. For a long time, really up until maybe 2010 and even 2012, one of the biggest misconceptions about developing anti-money laundering programs was that an institution or a CEO or a board really didn't have to worry about how robust their anti-money laundering program was if they really didn't suspect that actual money laundering was going through their institution. But what happened, and really it came about in some respect as a result of the financial crisis in 2007, 2008. When banks or other financial institutions for a long period of time, as the BSA-AML laws developed, were required to have these anti-money laundering programs. But if a financial institution fell short, if their program was non-compliant, it was usually addressed non-publicly by what's called an MRA, a matter requiring attention. And it was handled very constructively within the community between the regulator and the financial institution, and they would have opportunities to correct their systems. What really developed after the financial crisis was this idea was that regardless of whether or not the government has established that money laundering or laundered funds have actually gone through your financial institution, if you did not have a fully compliant program, that started to result in huge fines for financial institutions. So in other words, the regulators didn't have to show that because of the weaknesses in your AML program, laundered funds went through your institutions. It was enough for them to show that your program itself did not meet all the core requirements. And the requirements are very specific and very detailed, and you have to be compliant with all of them. Just to give you a sense, in 2012, the Senate Banking Committee, the Permanent Subcommittee on Investigations, the ranking minority member of that committee were doing hearings on a non-compliant HSBC program operating in the United States. And they had the chief of the OCC, the Office of the Comptroller of the Currency, one of the most important regulators in the country, before the committee. And he said to the director, "You're supposed to be a watchdog. You're acting more like a lapdog." Well, that clearly sent a message that you better bring your programs up to snuff. And in case you don't get the message, we're going to fine financial institutions starting out in the hundreds of millions of dollars, which in around 2010, 2012 was unprecedented, but it got up into the billions of dollars. So that's why all financial institutions have to be very vigilant about having a program, updating the program, staying current with the regulations, regardless of whether the government is able at any point in time to prove that actual money laundering has occurred.
And I would absolutely echo everything that Jeff has said. I don't think there's any sort of great difference between the US and the UK in that respect. I guess I would sort of summarize it as there are 4 reasons why, if I ran a financial institution, I would care about money laundering. I think first, as Jeff has already mentioned, the fines for non-compliance are huge. In 2019 in the UK, we had 12 fines for money laundering failures. Standard Chartered probably tops the charts, and it was fined over £100 million. Second, there is the risk of imprisonment up to 14 years inside for money laundering failures. Again, like everything else, the sentences are increasing. The average sentence is increasing every year. Third, the Financial Conduct Authority in the UK does actually have the ability to wind up or restrict the operations of firms that have been found guilty of wrongdoing. And finally, and I think it's particularly relevant at the moment as we see all of the press about the FinCEN leaks, money laundering breaches will hit the headlines. There is nothing more sobering for the chairman of a bank to read that his bank might have been involved in terrorist financing, or I think in some cases there's a suggestion that the banks have helped in the Arab Spring. And off the back of those reputational hits, we certainly have seen share prices for banks tumbling.
So what's interesting about what you've both said is that there are sort of 2 risks. There's the risk of actually permitting offensive behavior to take place, but there's also the potential risk that simply your program is deemed to be found insufficient without necessarily the finding that bad acts have taken place. I'm curious, when you look at a program for its sufficiency, are there red flags that compliance officers and in-house executives should be keeping an eye out for?
Yeah, and it's interesting also, Matt, because you would think with all that has happened that these compliance officials wouldn't have a hard time keeping their eye on it. And one wonders why we continue to see these large public enforcement actions and even DOJ prosecutions when now there is just so much data out there. There's the congressional reports. There's the Department of Justice deferred prosecution agreements or non-prosecution agreements. There's the regulatory public enforcement action publications. There's the actions of FinCEN and their reports and their fines. And of course, we, Zoe and I have our hands full keeping up on all of these public enforcement actions and other data, which is, we spend a lot of time doing so we can keep our clients up to date on all of these developments. And of course, FinCEN, for example, issues regular guidance about what's required. But it seems to me that the 2 problems that we continue to see in financial institutions and what compliance officers in a number of different industries, because now the Bank Secrecy Act, what is referred to as a covered financial institution, has become enormously broad, and Zoe touched on that earlier. Is that they're not, even if everyone has a BSA AML compliance program, and you cannot take too much comfort in just the existence of that program if you're not constantly evaluating that program and if you're not testing that program. And then even if you are evaluating and testing it, the second problem, and this has also been pointed out in all the guidance and all of the public enforcement actions, it's what's referred to as the tone from the top. If these matters are not being taken seriously by the board of directors, the CEOs, the high-level management, then you can't expect other people in your financial institution to take it seriously as well. So what's of great concern to the regulators is to see that this is something that's emphasized from the very top of an institution. And if they set the tone from the top, we do find that there are less problems if you have a well-functioning compliant program. Zoe?
Yeah, again, Jeff, I completely echo what you're saying. Certainly, my experience over the past sort of 15, 18 years is that things go wrong when people treat AML like a box ticking exercise. When people don't apply some common sense, a healthy dose of skepticism and curiosity, people should be asking, why has an organisation that's previously made, £10,000 a year suddenly making £1 million a year? Why is a car wash that is charging £5 to valet a car taking such a high number of £50 denominated notes? It's that healthy dose of curiosity, I think, that makes people, or rather the lack of that curiosity, that makes people fall foul of the law.
And so I'm curious, from your position in private practice, right? I understand that sometimes you come in to review an AML policy, sometimes you help a client improve or create an AML policy, and other times you come in because there's been an alleged violation of law or an allegation that the policies and procedures are insufficient. So taking sort of your experience in private practice into account, are there any sort of immediate or obvious piece of advice that you want to leave our audience with?
Zoe?
Echoing what Jeff has said, make sure that the tone at the top is correct, make sure that the culture is correct, make sure that people know what they need to be doing and that they are doing it, and monitor and check to make sure that people are doing what they should be doing. I guess finally, make sure that you've got the resources in place to do it.
Matt, I would say three things there, and some of these are very recent developments. But again, some of the most recent important guidance in years just came out this summer from FinCEN and from the bank regulatory agencies in the U.S. And there are three things I notice. A very important part of any anti-money laundering program is this ability to what's called customer onboarding, or know your customer, or customer due diligence. So you're not only supposed to know what your customers are doing, you're supposed to know who they are. Because as Zoe points out, if you don't know who they are, it's hard to evaluate whether their transactions make sense for their business, right? There's an effort now to try to get behind the signatories, for example, on an account, and get to what's called the beneficial owner of the accounts. So banks really, and other financial institutions, really have to closely monitor not only who they're doing business with, but who is acting behind those people that they're doing business with. It's an enormous additional responsibility, but the recent guidance has pointed out just how important this is to the regulators. The second thing I would point out, based on some recent guidance and publications, it seems to us that there's going to be a trend where there's going to be more, and it's true generally in the regulatory world, right? There's going to be more of an effort to hold individuals, whether they are CEOs or board members or managers or directors of compliance, personally liable for compliance failures in their BSA AML programs. It may not result in criminal prosecution, but certainly civil enforcement, large fines for the individual, and it could result in criminal prosecution if these individuals are found to be not only in any way complicit, but also if they engage in gross negligence, which can be a very difficult standard to ascertain. And my final point, which is really something brand new, but again, we see it in other regulatory areas, this idea of voluntary self-disclosure. We've seen it in the FCPA world, export control sanctions, where the government has laid out very detailed guidance on when and how one should self-disclose failures in your compliance program, or even complicit or criminal behavior, in order to reap the benefit of that if you disclose before the government becomes aware of it. So this is also now bleeding into the BSA AML world. And FinCEN has just recently came out with a guidance that kind of details when and how one should voluntarily self-disclose a compliance failure. So this has added another arrow in our quiver for Zoe and I, because now we're not only evaluating whether the program is sufficient, whether it's up to date, whether it's been tested, but now we have to advise clients on whether or not they're in a position where it would be advantageous for them to voluntarily self-disclose a compliance failure.
And if I may, just picking up on Jeff's very sensible comments about sort of looking round corners and what we can expect. Cryptocurrencies is obviously going to be a massive issue going forward, and regulators are going to be looking more closely at that. I think we can also expect a lot more around transaction monitoring. I think we can also expect a lot more automated programs, ones that will make sure that money laundering is picked up more efficiently, more quickly, and that people who are actually laundering funds are spotted amongst the legitimate money that is flowing through banks.
You guys have covered a lot in a very short period of time, and I look forward to doing this again with you where we can delve into some of these topics individually. Thank you both for joining.
Thanks for having me.
Thank you.
So that does it for another episode of Steptoe's Financial Services University. Today we covered anti-money laundering regulation. So please check out more of our episodes and learn more about our financial services practice at steptoe.com. Thanks for watching. We'll see you next time.